All right, we are live on YouTube. Gonna get the recorded started right now. If you're watching the live version, you can watch the recorded version with the intro. It does have timestamps, so you can look at each topic that we do discuss within the video instead of just watching it all the way through. You can kind of select which type of topic you'd like to, learn about, read about, listen to, all that stuff. So I'm gonna raise it just up a little bit, and then let's get this going. Hey traders, welcome to another global macro update. Quick update on the COVID spread. We have the total confirmed over 3 million now. US coming up to 1 million here in terms of the total confirmed cases by country. In total deaths, you see that there is over 200,000, so obviously not great, but countries are talking about easing lockdown and letting some non-essential businesses start back up. So we'll talk about that a little bit more in detail in this video. First thing I wanted to discuss in terms of the economics is the things that are going to be coming up. We just had our consumer confidence statistic come in, which we'll talk about in the next post. But for tomorrow, we got a lot of stuff. We got the GDP, which is absolutely huge. The forecast is negative 4% contraction in the GDP. We'll see how that comes out. I am living on the West Coast, so it's going to be coming out pretty early at 5:30. And then we got pending home sales, crude oil inventories. We got FOMC statements, interest rates. That'd be interesting. The forecast is not going to be changed. And then initial jobless claims, which hasn't really impacted the market really that significantly compared to the amount of actual initial jobless claims that are coming in. Obviously, if you have been watching our videos, you've seen the chart. It really broke the chart. We haven't seen anything like this in terms of the numbers. And then we got the PMI numbers to end it off for this week. Next week, we don't have a whole lot. We just have non-farm payroll, I believe. If this does load, maybe not, we'll just skip it. That's all good. I believe next week is just non-farm NFP. And then this is going to be looking at the consumer confidence that came in. It was lower than what was forecasted. Forecasted was 87.9, came in at 86.9. And we can see it's not that crazy low in terms of, in my opinion, we're in a complete lockdown where basically every single non-essential service is closed, yet the consumer confidence is sitting at 86.9. We can see that was around 2008, 2009 in the great financial crisis. And then 2000s in the dot-com bust, we hit around the lows of 61. I guess that was when we had 9/11, and the lows of dot-com was around 85. So we're around the same area as the low of the dot-com, and we've definitely seen lower with 08 as well as with 9/11 there. All right, going on to what is going to be the potentially big mover for the equities market is going to be the GDP quarter over quarter. We can see that we haven't really had a negative quarter in a very long time. The last one was in 2015, and we haven't really seen some major negative growth all the way until basically 2008, when we had that great financial crisis there, where it contracted over 6.3, 6.2, which is pretty bad. So right now the forecast is set out to be negative 4. So we'll see how that goes. That would be kind of within this range at the start of 2009 right there. That's when we had that negative 4, and then it collapsed down to in the low 6s, negative 6.3, 6.2, somewhere like there. So we'll see how it goes. We'll see what the number is tomorrow morning, and we will provide a global macro update going over the charts, because obviously if it is a big number in terms of how negative it is, it will impact the markets, but if it's not as bad, obviously it would be a little bit more bullish. Next thing we're going to be talking about is Germany's coronavirus infection rates edges higher after lockdown measures eases. So there are a lot of countries who are talking about potentially easing the lockdowns, letting some non-essential businesses open, but this does create a risk for a second and third wave, and we already have seen countries that have taken really extreme measures when they do try to ease back up and allow the economy to start back up again, there are second and third waves. It's not like a one and done situation. And it's a fine balance between the economy and the health of the citizens for sure. So Germany's coronavirus infections rate has edged up, prompting concerns. Germany has already started to relax lockdown measures. So we'll see if they have to go back into major lockdown, if this one single time did enough, and then they're able to kind of have that fine balance between being able to open up the economy as well as being able to maintain safety for individuals. All right, quick look at some global numbers here. Spain's daily coronavirus death toll rises slightly. Indonesia reports 214 new coronavirus infections, 22 more deaths. We've got nearly 200 new cases and 10 additional deaths in the Philippines. Russia reports almost 6,200 new cases. Total surpasses China. That's surprising when I read that. Actually, you can't really trust Chinese numbers. That's the issue with that. Singapore preliminary confirms almost 800 new cases, and Thailand reports 9 new cases and 1 death, so not so bad. Germany reports over 1,000 new cases and 110 deaths. I think that's about it. China reports 3 new cases, no additional deaths. Yeah, you got to be a little bit careful what comes out of China's in terms of the numbers. Australia reports 10 new cases. New Zealand sets to ease restrictions. This is what I'm talking about, is countries around the world are now going into a point where they might ease restrictions. They might have basically try to have that equilibrium where they're able to start the economy, start to get individuals back to work, start businesses back up, but then also maintain social distancing, maintain the, try to maintain some level of social distancing, you can see right here, and the ability to try to curb this spread. So that's a bit of like the more global news. We're talking about, obviously, a huge topic at hand is COVID. The next thing we're going to look at is just a discussion about inflation. I know a lot of people are talking about it. I see a lot of people talking about how, obviously with the monetary base increasing so substantially, like we've seen at the start of 2008, when the Fed has stated they're going to do unlimited QE. Obviously, it is concern for inflation, but in my personal view, I do not think we are in risk of inflation just yet. In order to have inflation, you need to have the velocity of the currency increase. You need to have people spending it, transacting it, using it within the economy. Right now, yes, we do have one ingredient of like hyperinflation, seeing prices of assets and CPI go up. You have one portion of it, which is the increased money supply, which you can see right here within the monetary base of M2, I believe. And then we can see we're actually in deflation. This is the consumer price index, or CPI. This is going to be the average price change of a basket of goods and services. And we can see we've been basically in inflation since the 1940s, 1947. We did have a little slump in 2008, where it's a little bit of deflation, and then since then it's really just been a straight move up. But it will come a time where we will be seeing velocity pick up. But right now, with the lockdown, with people saving, with not a lot of people really being in a position to be frivolous, a lot of people lost their jobs. I think saving is going to be a mindset for a lot of individuals, especially if you lost your job and you're down on your luck. You're not wanting to go out and go shopping and spend a lot of money. You're going to want to save. You're going to want to conserve your capital because you don't know when the next rainy day is coming. And we can see the velocity of M2 money stock is going down significantly since basically the early 2000s. This is 2001. Huge drop in velocity. Got a little bit of a pickup when we saw the boom of the housing bubble. And then once we saw 2007, 2008, there was a huge decrease in velocity. And since then, we haven't really seen it pick up. And this is on a quarterly basis. So when Q1 does come in, we'll see how much slower it is, and I think we'll really start to see the economic stats show the negative impacts in Q2 of 2020. So we'll have to wait a little while for that to come in, but I think that is when we'll have that second, more economic understanding of how bad it really is. Last thing we're going to do to top it off is just go back in time and look at Japan's lost decade and what this period of Japanese history teaches us about financial crises. In my opinion, it's not exactly the same, but there are some similarities that the US currently has with Japan in the 80s, and then they had their lost decade in basically at the end of the 80s, at the start of the 90s until the 2000s. Really, for an entire decade, they couldn't get out of deflation. The prices of assets were going down. The stock market was going down. Real estate was going down, and it never really picked back up. So let's read into it. Japan's economy was the envy of the world before scrambling to one of the longest running economic crises in financial history that would come to be known as the lost decade. In the 1970s, Japan produced the world's second largest gross national product after the United States, and by the late 1980s ranked first in GNP per capita worldwide. So they were booming. But all of that ended in the early 1990s when its economy stalled. Alright, what caused Japan's lost decade? Most economic crises immediately follow an economic boom or valuations disconnected from reality. Does that sound like something? We'll get into something that is able to measure potentially a valuation of equities versus the GDP. For example, the dot-com bust and the Great Recession in the United States immediately followed several record US stock market valuations. So this is what happened in Japan. Record low interest rates fueled stock market and real estate speculation that sent valuations soaring through the 1980s. That sounds very, very similar to what the United States saw post-2009 when they dropped interest rates and artificially kept them there for, I believe, 7 years until 2015, 2014, something like that. They started slowly raising the rates, but They kept them there for very long. And look at Japan, negative interest rates now. Look at Europe. There are countries like Switzerland, Sweden, Germany. I believe there are a few. I don't exactly know how many all of them are. But there are negative interest rate monetary policies that are actually being implemented in many countries around the world. So yeah, that's record low interest rates if you ever ask me. Let's look down a little bit deeper into this. Economist Paul Krugman blames the lost decade on consumers and companies that save too much and cause the economy to slow. So definitely some people think that, in a Keynesian economist viewpoint, savers should be punished and everyone should be a good consumer and consume as much as they can. Because that drives the economy. And yes, it does, but, just basically saying savers are to blame, I don't think is the right way to go about doing things. Other economists point blame at the country's aging population. That totally makes sense because the demographic will play a huge role within society, within economics. When there's a huge demographic cycle and a large population going through an economy, it's at first very inflationary because there's a large group of individuals buying their first car, couch, bed, house, all the large ticket items in life, clothing, but then when they leave, they are mostly sellers when they are retired. If you're living off of interest, you are either, trying to basically maintain your wealth, slowly grow it, and as time goes on, if you go on trips, if you go vacations, if you buy any other items that are large, you're going to sell assets to fund those expenses, and you're more of a seller than a buyer. Following the crisis, many Japanese citizens responded by saving more and spending less, which had negative impact on aggregate demand. This contributed to deflationary pressures that encouraged consumers to further hoard money, which resulted in a deflationary spiral. So this is going to be the velocity of money. This is how fast people are transacting currency, and this is the consumer confidence. So this is why stats like consumer confidence is important, because you're able to understand, are they wanting to spend money? Are they going to go out and, go on a date, go out and buy some food, go to the bar, go out and watch the game, and, just be more of a consumer and assume that your future is more prosperous compared to a saver who is saving for a rainy day, not spending money because they assume that there's going to be negative, turbulent times ahead. Now to finish it off, before we get into the charts, is the market cap to GDP, or Wilshire 5000 GDP ratio, created by Warren Buffett, or thanks to Warren Buffett. Market cap to GDP is a long-term valuation indicator for stocks. It has become popular in recent years thanks to Warren Buffett. Back in 2001, he remarked in a Fortune magazine interview that it is probably the best single measure of where valuations stand at any given moment. So it's widely accepted as a definitive benchmark for the United States equity market and is intended to measure the total market capitalization of most publicly traded companies headquartered in the United States. And this dates all the way back to 1971. Now, we do have it date back further, but we're just going to watch, obviously, the more recent price action here within the last handfuls of decades here. So first things first, the mean average is sitting at around 0.8. The high of 2000 at the dot-com bubble was around 1.45, 1.40, and then the low was around 0.7, right around there in February of 2003, which was around a 52% drop. In 2007, the housing bubble in the United States, the market cap to GDP was around 1. We can see it's just sitting maybe a little bit around 1.06, and then dropped down to basically 0.5, 0.53. So let's say it's just, around 50% drop in market cap to GDP. So both times in 2000 and 2007, we had a 52% drop roughly, and then around a 50% drop. What we're seeing right now, let's zoom into the more recent price action. From the high of around 1.57, we didn't hit 1.6, we were just shy of 1.6, and the low was, let's just zoom in a little bit closer here, was around 1.1-ish. So, 36-ish% drop, I believe, somewhere around there, which is a lot less than 2000 and 2008. So, in my personal view, this is going to be more of a bias on how negative do you think that COVID and oil capitulation is to the United States economy. Because at the end of the day, stocks have to couple back with reality in some sense. Yes, there can be distortions where they're decoupled, where stock valuations aren't representative of economic health. There's definitely times of that, but there can't be a massive capitulation in the economy with a huge deflationary downturn for a multi-year time frame, and then the stock valuation just continue going up. I just don't think that's possible. It hasn't happened, right? Like, every economic bust ends with the stock market going down in value as well. Like, imagine 2008 and how negative that was, but then the stock market still continuing to go up. But then now you have an entire economy, but not just the United States, but the entire globe that is in complete lockdown. Yes, there are some easings of that, but at the end of the day, I'm sure everyone is well aware of the devastating impacts that this has. And then layer on oil prices, layer on the fact that basically all oil companies in the United States cannot produce oil profitably, basically, with how volatile it is, with negative oil prices. There's no more supply space available, and until this lockdown stops and there is a reopening of the economy, airplanes are going, trains are going, cars are going. There is basically, cars and things needing oil. There's not going to be that demand there. There just isn't. So until the fundamentals are changing, I don't think that the capitulation will stop. So that's basically looking at it, 36%. And if we're seeing, like we saw in 2000 in the dot-com bubble and 2007 in the housing bubble, if we're looking at around a 50%, let's say, we're looking at just shy of 0.8. Right? So we're around here. And then if we go to around 50%, like we had in the two previous market crashes, it would be around 0.8, so just under the mean average. So that means that if we're looking at previous historic timeframes, we can't extrapolate exactly from the past and say this is what's going to happen in the future. That's not how it works. But if we're able to understand what happened in the past and then compare, contrast, that is speculation, right? No one has a crystal ball and says this is exactly what's going to happen. Some people are bullish, some people are bearish. But in my personal view, this is more detrimental to the economy than what we had in 08, 2000, and some people are even comparing it to the 1930s Great Depression. So it's not just me who has that viewpoint. There are, leading economists that do think that this is absolutely devastating, and we've seen massive pushes to the downside and then a pullback that is above 50% before it's happened, and we did move to the downside. So my bias is still exactly the same. I'm still bearish because we've only really seen max a 36% drop from the highs in market cap to GDP, whereas in other economic downturns where we saw stock market crashes in recessions like we are in right now, we've seen 50% or more of a decimation in the market cap to GDP. So that's my personal viewpoint. Obviously everyone has a different point of view, but that is kind of another reason why I'm still having my bias. And now let's look into the charts. I'm going to quickly have some water and then we'll dive into the price action here. All right. I'm going to get my snip and then let's just talk about what we can see on the 6-hour chart here. So we did get an open that was quite a bit higher. These are contracts, so they're trading on a different time frame compared to the equities market. They trade for longer hours like futures. But anyways, we see that we did get a pop up. We opened higher. We did slam back down, back below the resistance level, which is good to see. We did get a lot of sell pressure coming in there as well, with a wick validating that there are sellers in the market. But it does look like we are holding that resistance just ever so closely, that if it does break, I think we could get another move to the upside. And then the last final level of resistance that we have would be the 618 level. This dotted red line at 29.51 represents just above the 61.8 fib level from the high to the low. And if it goes above there, I'm going to have to ease off, change my bias. I will get closed out of my short position. I do have a short on this current trade, and this is basically my stop loss. If it goes above there and holds, I'm just going to say, you know what, I'm wrong. I'm going to wait. I still do have a bearish bias within the S&P, because at the end of the day, it's not bullish. There's nothing bullish about the economy. It just doesn't make sense to me. There's no fucking way that there can be a bull run and see highs and break highs when we have 26 million people losing their jobs in 6 weeks, and unemployment, when we get the numbers, potentially hitting plus 20%. That is recession, depression numbers, and there can't be that distant disconnection between the equities market and the real economy. So I'm going to have my bearish bias even if we hit the 2951 stop loss that I currently have. But if we're holding this level of resistance at around 2880, we can probably safely assume that we'll get some consolidation until we actually see a drop. We have a first support, second support, third support. We might get a third and fourth, but at the end of the day, we are looking at this as a potential ascending triangle, which is, yes, a little bit more bullish, but we can see this sort of pattern appear before. We'll look at the Japan's asset bubble in the 1980s and how that popped, what happened to the price action, and how it kind of looks like what we can see right now. So first off, I just want to kind of give you a good understanding of what happened in my view. We had a wedge like there. Lines aren't perfect, but we had a nice wedge. Massive move to the downside. The wedge is our pullback, and this is the 50 around here to the 61.8% fib level. And then what we're seeing right now is initial push to the downside, major rejection from the bulls, and then we're getting a second attempt for a leg up in order to retest those highs. You can also call this a double top as long as it holds. What happened in Japan in 1980s? This is the exact chart. We can see 1990 right here. This is the start of the 90s for Japan. We got a massive move to the downside. It dropped 29% from the high. It retraced, it pulled back to the 50% level. Had a nice ascending channel, very tight consolidation. We initially got a push down. I think a lot of people were expecting this to continue further down. We got a bounce holding a previous level of resistance and support, creating a sideways consolidation. Initially, you would draw this trend line, I'm sure, like here or like here, but you draw some trend line connecting the lower highs because this is the high to break. We got the price to go all the way back up to the high, creating a double top. Once this double top held, we can see the price held multiple times at this zone. Once you started to see the momentum, and especially once you started and saw that breakdown to confirm the double top with the neckline broken, that is a point where, in my opinion, we should really be thinking of potentially adding a significant amount on at that point, because that's definitely a major rejection. And that would be the highest confirmation location to potentially add to a short in my personal view. But bringing it back to what we can see right now, let's just bring back our fibs, and then let's just take away this and this for now. Actually, I think that's a pretty clearly shown chart we can see. Notice the similarities from Japan and the current price action. We did have a wedge or an ascending channel, very similar in terms of the structure towards the upside. We broke, we tried to push to the downside. This wasn't as significant, but it still pushed to the downside, broke the support, and then we held the demand zone multiple times, and we start seeing a series of higher lows push the price, retesting the high that we saw right here. So the way I'm looking at it is now going to be a double top. If it breaks this zone, going to be very worrying for the bears. Definitely would be a lot more worrying for definitely people shorting for longs. I don't think it's out of the woods yet. I'm still going to be looking short even within this range right here. It doesn't really matter because we've seen it hit the 618 before and then move down, so that's why I'm going above the zone. But at the end of the day, I'm still bearish. I really am. We can see a little channel right here. I think if we do start to see a hold of this resistance zone and then a push down further, I think that would be a little bit more favorable for the bears. But you know, I'm not an absolute perma bear. If it does just continue to trend up, I'm not going to continually try to add shorts. If I don't know what's happening, I just won't enter a trade. It's just simple as that. Right now, I feel like I still have edge. I totally still have a good understanding of what's occurring in the markets in my personal view. There's still a lot of fundamentals that are going to be coming into play for this week with the GDP numbers, with initial job loss claims not really going to be doing a whole lot in my personal view because they've been coming out in waves. It's a weekly report, and it really hasn't done much to the market. We can see this is the chart right here. We talk about it often. You know, since March, it's just been millions and millions of people losing their jobs on a weekly basis. We see 3 million people, 6 million people, 6 million people, 5 million, 4 million. We're seeing millions of people lose their job on a weekly basis. And this isn't, it's not like people are losing less jobs here. They're still losing 6 million brand new, 5 million brand new, 4 million brand new. That's a shit ton of people losing their jobs. So, you know, share buybacks are not really to its full potential, obviously, with COVID, with oil. Some companies are obviously able to, Netflix, Amazon, companies that are somewhat benefiting from this. They have the increased cash flow to buy back shares if they would like to. But for a lot of companies, they don't have the capital. They don't have the revenues to be doing that at this point. So, you know, that's a little bit more bearish as well. So I do obviously have a bearish bias, so I'm going to kind of funnel information into that bias because like in these market conditions, if you are not a short-term day trader, you can't be bearish biased and then bullish biased on a flip of a switch every other day, because you're just going to get annihilated in terms of the amount of trades you're taking, in terms of the fake outs. Yeah, it's very easy to get faked out if you don't have a bias, but you know, for the fundamentals, I'm super bearish, which then plays into the technicals. So that's basically my analysis. You hopefully got something from it. I thought this was pretty interesting, market cap to GDP. If you'd like a link, let me know in the Discord or in the comment section below on this YouTube, and I'll be happy to post that within the comment section below. So that's going to be the completion of the video. I will answer all questions within the YouTube because we are doing this live on YouTube as well. So thank you very much for watching, everyone, and until next time, have a good one. All right, let's play that. So in the comments, Darian said, I almost gave up my puts this morning. Yeah, it definitely pushed up a little bit. It pulled right back pretty aggressively back to kind of the range that we were in, but yeah, it's definitely gaining a decent amount of buy volume. Personally, I think the risk reward is phenomenal on this trade in terms of where it's going to go if it does dump to the downside versus the risk you are having. As long as you're entering in decent spots and you're able to manage your position size. But yeah, I'm definitely bearish biased, and I'm sticking with my guns with the direction of the market here. And I like to be, if it goes above 61.8 and then I get stopped out, because that's going to be my stop loss, that's a little bit shitty, but that's how life goes. You can't win every single trade. But if it does actually go back above 61.8 and then start coming back down, I'm still going to be interested. But I'm definitely a little bit surprised that we were actually able to step back up above the zone. If we look on the 1 hour, we pushed up above the zone. We did come right back down into it, but the 1 hour and 4 hour closed above that area. Major rejection on the 4 hour with the price coming right back down below. But yeah, I was definitely surprised by that. Although one good thing, using VSA, we do see that the bullish candle on the way up didn't get nearly as much transactional volume as the bearish push on the way down. So definitely a lot of transactions pushing the price back down, but to say the least, I was definitely a little bit surprised, especially when we broke out of this little wedge, when we started to see that big drop with the candle closure basically right at the bottom. You know, looking for a little pullback. We did see a nice wick here, closing right at the 50% fib level, which I thought was great. And then these 3 days here, a little bit surprising, but I'm still holding my bias. I'm still holding my short until if we get above the 61.8, then I'm going to have to call it. But yeah, I was definitely a little bit surprised that we're continuing to move up here with all the economic data that's coming out that is super bearish, but we're pretty disconnected from reality right now. All right, Kai Smith, what's up? How's it going? So I think I'm gonna cut off the live here. Don't really have any more questions. TikTok I didn't really do. My phone, I did not charge it the night before, so that is not going to be unfortunately available on TikTok. But those don't save, whereas the YouTube videos do save. So thank you very much for watching, everyone. Hope you enjoyed the video. Until next time, have a good one.